says right here that for Chapter 9, we have the after-tax cost of debt. And you can see here, we're going to go with 13% and the tax rate of 0. And this is the little formula right here that I plugged in. And so with this formula here, I can just plug in my number. So my R sub D is the cost of debt. And so they told me it's 0.13. I multiply that times 1 minus t, t being the tax rate, which happens to be 0. So obviously it's going to be 13%. Okay, so that's the answer, is 13%. The second one here, it's almost the same formula. I'm just going to copy and paste it. Only the difference now with this one is the tax rate's 0.2. So 1 minus t is 20%. And now I get 10.4%. And the third one is the tax rate is 35%. So now I go 1 minus, instead of 0.2, I go 1 minus 0.35. I get 8.45%. So I'll just format those so you can see the decimals better. That makes more sense probably. So pretty simple. It's just understanding those two numbers. Okay, then question 2 is almost the same question. It says LL Incorporated currently outstanding 11% coupon bonds have yield to maturity of 8.4. LL believes it could issue new bonds at par that would provide a similar yield to maturity. If its marginal tax rate is 25%, what is the after-tax cost of debt? So the concern with this one would be they gave me two interest rates. Which one do I use? And they're trying to throw you off the trail, which is why I chose this question. You want to use yield to maturity. That's always the yield you want to use. That's the market rate of interest. And that's what I want to use, is the market rate of interest. So with this one, I'm just going to copy this formula here. We'll just plug in our new numbers. And so I'm going to take, instead of using 0.13, I now will have 0.084 times 1 minus t. In this example, t is 25. Okay, so my answer now is 6.3%. Okay, so the key with a question like this is I want to plug in yield to maturity, and I don't want to use the coupon rate. Okay, then question 3 is, what's the value of my preferred stocks? And basically, what's the required return on my preferred stock? So we're really solving for rates, and that's what the WACC is. It's a rate. And so we just did a few examples of solving for debt, and now we'll do an example of solving for preferred stock. So it says here, Duggan's Veterinary Supplies can issue perpetual preferred stock at a price of 50, with an annual dividend of $4.50 per share. Ignoring flotation cost, what is the company's cost of preferred stock? Flotation cost is basically the commission that you would pay a stock broker or an investment banker to sell your stock for you. They just said ignore that, but in reality, if they were going to be issuing preferred stock to the public, there'd be a commission to pay to an investment banker who helped you, do the deal. We're just ignoring that. So let's plug in the dividend of $4.50, and we just divide by the price because I don't have to worry about the 1 minus f. So the answer is pretty simple. It is 0.09. Let's convert that to a percent here, and that will turn into 9%. Okay, so the answer is 9%. And I want you to note that when it comes to the WACC calculation, only debt is tax affected. Nothing else is, because companies are allowed to deduct interest to compute their taxable income. So you do get a tax break for having debt because the interest is tax deductible, but dividends are not tax deductible. So that's significant to know that. There's nothing in this calculation about taxes. Okay, now we'll go ahead and change it up and say Burnwood Tech for question 4 plans to issue $60 par preferred stock with a 6% dividend. Similar stock sells for $70. Burnwood must pay a flotation cost of 5%. What is the cost of the preferred stock? Okay, so we're going to compute what the dividend is, and you compute that as a percent of par. So the DPS is simply the $60, the par, times the percent of 0.06. I get 360. Then I divide that by the value. Well, the value is what's the market price, okay? The market price is 70, just like we used for the question above it, the market price was 50. So I'm going to take that and divide by 70. Now the difference though with this one also is that now I have a flotation cost. So I have to multiply that 70 times 1 minus F, and F is 0.05. Okay. Oops, let me hit enter there and fix my formula. I'm taking 360 divided by 70 times 1.05. So I do the math, do the division, and we get our the return, and that would be, looks like it's going to be 5 point something, 5.41%. Okay, so that one is just a little bit more complicated than the first one, but they're really not too bad. Okay, then we'll go look at question 5. And question 5 is about dividend growth. It says that Summerdahl Resort common stock is currently trading at 36. The stock expects to pay a dividend of $3 at the end of the year, and the dividend is expected to grow at a cost rate of 5%. So what's the cost of common equity? So the three components of equity are, of the WACC, I should say, are the debt, the preferred stock, and then common equity. Okay, and common equity could also include your retained earnings. So we have common stock trading at 36, expects to pay a dividend of 3, and a growth rate of 5. So here's my formula for R sub S, basically the required return on that stock, S meaning stock. It's D1 divided by P0 plus the growth rate. So I'm just going to insert a couple of rows here to give myself some room. So D1 is 3 because it says, the way it's worded, expected to pay a dividend at the end of the year. So D1 is 3, so I'll type that in. And then, whoops, I moved my PO by accident there. So the PO is the price of the stock today. That's the 36. Okay, and my growth rate is the 0.05. Okay, so there's my form. I'm going to move this down one. Okay, so it's right there. So let's go ahead and take the 3, and we divide the 3 divided by 36. Okay, and then I take that number and I add the 0.0833 plus the 0.05, the sum of those two, and that's my R sub S, which is 13.33%. Okay, then we get down to what they call the CAPM. This is question 6. It stands for the Capital Asset Pricing Model. It says that Booher Bookstores has a beta of 0.8. The yield on a 3-month T-bill is 4%. The yield on a 10-year T-bond is 6%. The market risk premium is 5.5%. And the return on the average stock in the market last year was 15%. What is the estimated cost of common equity using CAPM? So CAPM stands for the Capital Asset Pricing Model. And it's a way to look at a stock and say that every stock's R sub S, its return, should be different based on risk. And so it uses the measurement of beta, which beta being a measurement of risk. And if you recall from previous chapters, a beta of 1 equals the market. The market has a beta of 1. So then if you have a beta above 1, you have a stock that's riskier than the market. If you have a beta of below 1, your stock is safer than the market. So 1 is the market, then you're either above it, which is riskier, or below it, which is safer. In our example, we're below it, which is safer. And then it mentioned two different T, which stands for treasury rates. T-bills are short-term, and T-bonds are long-term. And when we're looking at the CAPM formula, we want to use the risk-free rate should be based on 10-year T-bonds. So they're giving us the 3-month T-bill right there as just kind of a way to get us off the track. We want to focus on using the T-bonds, the 6%. So here's my formula right here. I'm just going to plug in my numbers for that. So I'm going to start with my risk-free rate. So I'm going to use the 0.06. I'm going to add to that my beta, which is 0.8. I'm going to multiply my beta by the market risk premium, and they mentioned that that was 5.5%. And multiply that times 0.055. So I'll do the math on that, and I'll get this answer right here, which is 10.4%. Okay, so 10.4% by plugging in my numbers. Now let's kind of check that number, and it says here the return on an average stock last year was 15%. So notice that the return on this stock is not 15%, it's lower. And that's okay because this stock is a less risky stock. I should not expect the market return because I'm taking on less risk, which means I get less return. So that kind of makes sense. Okay, and then question 7, it says that Shy Imports balance sheet shows 300 million in debt, 50 million in preferred stock, 250 in equity. The tax rate is 25%. And if they want a target capital structure of 35 and 65, what is the WACC? Okay, so we can go ahead and plug this in, and you can see the formula right there. So I'm taking the returns of each of these, and I multiply that by the weighting. Okay, so the weighting is the W is the weighting, and then R sub D is return on debt times 1 minus T, T being tax. And then I've got the preferred stock, and I've got the common stock over here on the right. So what I think I accidentally did is I accidentally took something out of this problem without realizing that I did. So I need to plug in a couple of numbers here because I think I accidentally took something out. So what I accidentally deleted when I set this up is that R sub D is 0.06. Okay, so we got that number. And then I accidentally took out that the tax rate was 25%. And I messed up the fact that R sub PS, return on preferred stocks, is 0.058. And then R sub S, that equals 12%, 0.12. So I accidentally deleted that. I realized I saw those commas there and realized I accidentally took something out. So I've got my weightings. I used the target structure. I used the 30, the 5, and the 65. So it doesn't matter what's currently in there now. The 300, the 50, and the 250, kind of irrelevant. I really focus on what the desired structure is. And that goes into my calculation for my weightings. That's really what I want to use. Okay. So I'm going to kind of do each section by itself. So I'll do the weighting of the D first. So WD is 0.3, and then I'll multiply that by R sub D, which is 0.06, and then I'm going to multiply that. I should put my star right there for multiply times 1 minus T, 1 minus 0.25. So that right there gets me my weighted cost of capital for debt. Let's do the preferred stock next. So that weighting on preferreds was 0.05, and I multiply that by my return on preferred stocks, which is the 0.058. Okay. Then do the same thing for this stockholders' equity. My weighting there is 0.65. I multiply that by the 0.12. Okay. So then I add those across. We just do plus each one. And I get to 0.0944 or 9.44% as my WACC. So the WACC is 9.44%. Okay, let's go ahead and do question 8, and we're in the home stretch here, so bear with me. Question 8 is David Ortiz Motors has a target capital structure of 40 debt, 60 equity, with apparently no preferred stock. Yield to maturity in the company's outstanding bonds is 9, and the company's tax rate is 25. Ortiz's CFO has calculated the company's WACC is 9.9. What is the company's cost of equity capital? So same formula here that I used here. The difference is that there's no preferred stock. What's different about this question is they kind of already gave us what the WACC is. They said they think it's 9.9. That's fine. We can do that. So I'm just going to put in 0.099. And that equals, let's compute the D part of that. So the WD is 0.4. the 40% debt, times the R sub D, which they think is 9, 0.09, times 1 minus T. 1 minus, and T is 0.25. Okay. So basically, I know that if the total WACC is 9, and they're telling me that the debt piece is 0.009, I can solve for the missing piece. Okay, so let's see, make sure I did this right. I took 0.4 times 0.09 times, oh, I missed this up. This should be a minus right there. I knew I didn't have something right. There we go. So now I'm good to go. So basically I'm saying 9.9 equals 0.027 plus, then the question mark being, what is the R sub S? We're going to have to solve for that. I'm just going to plug a question mark there. What is my R sub S? So to get to that number, and I know my weighting on R sub S is 0.6. So what I can actually do is say 0.6 R sub S would be the last piece of the puzzle. So I now have to solve for the R sub S. So to do that, I have to kind of simplify my formula. And so what I do is I subtract the 0.027 from the left side. So I take the 0.099, I subtract the 0.027, and so I get this should be 7.2%. Let's see. I'm not sure why my formula didn't quite work there. So I did multiply again. No wonder it didn't work. I don't know what I'm doing wrong. There we go. 0.072 is what I want. And then that kind of equals just 0.072 equals 0.6 RS. Okay, so now I can divide by 0.6 and I'll get my answer. So if I take plus 0.6 divided by 0.072, I should get my answer. And I think I'm actually maybe did that backwards. I think I have to take the 0.072 divided by 0.6. There we go, and 12% is my answer. So just want to see what I did there. I took the 0.072 divided by 0.6, and I get 12%, which is my R sub S. So unfortunately, there's a little bit of algebra there to work that one, and they like to do that to you. They give you a straight formula, and you solve for one little piece of the formula over here on the right. Unfortunately, they like to do that one to us. Question 9 says a company's 6% coupon semi-annual payment, 1,000 par value bond, matures in 30 years, sells today for 515.16. They have a tax rate of 25%. What is the firm's after-tax component cost of debt for purposes of calculating the WACC? So again, I plugged in one of those little formulas from my present value, future value spreadsheet. And so I already plugged in the numbers on this one. But I wanted you to see how we do this for semi-annual. So the payment is 30%. That's based on the coupon rate. So the par value is 1,000. I multiply that by 0.06, but because this is a semi-annual bond, I divide that by 2. So every 6 months, we pay $30 worth of interest. The future value is the amount of the bond when it matures, which is 1,000. The present value is what the bond sold for today, the 515.16, and the number of periods is the 30-year bond times 2, which is doubling the number, so 60. So that gets me down to an interest rate of 6. But because this was semi-annual, I actually have to double that answer. So that's why I have this number right here. I have the 6 times 2 for 12. So my answer is 12. Well, then I have to plug in this formula here. So my answer is plus 0.12 times 1 minus t, t being the 0.25, and then I get my answer of 9%. Okay, so my true answer is 9%. Okay, then I do one left, then we're done. So question 10 says the earnings, dividend, stock price of Shelby Inc. are expected to grow at 7% per year in the future. Shelby's common stock sells for 23. The last dividend was 2, and the company will pay a dividend $2.14 at the end of the current year. Using the discounted cash flow approach, what is the cost of equity? So we're actually going to go through and do 3 different methods to compute what R sub S is, which is pretty common. And then we can average those out to say maybe that's the best answer. So we're going to start out with doing the discounted cash flow approach using the dividend piece. And so we're going to plug in the 2.41. So I'm using this model right here. So I'm going to plug in the dividend 2.14. The price of the stock today is 23, and the growth rate is 0.07, expected to grow at a rate of 0.07. So my answer is 2.14 divided by 23. Okay, that's 0.093043. I'll add this plus my growth rate of 7%, and that's my answer right here. So I get 16.3%. Then it says if the firm's beta is 1.6 and the risk-free rate's 9, the expected return in the market is 13, what would it be using the CAPM approach? So I've got the CAPM formula here, and we'll plug in the numbers. We go the risk-free rate. They told us was 0.09. So I do plus, and then I take R sub M, which is the market return of 0.13. I then subtract the risk-free rate of 0.09, and then I multiply that times the beta, which is 1.6. And I get 15.4%. Okay, so using this approach, I get 15.4. Using the first approach, I get 16.3. Then the last formula is here. It says if the firm's bonds earn a return of 12%, what would be your estimate using what they call the own bond yield plus judgmental risk premium approach? And it says use 4%. So the chapter talks about there's studies that show that for most publicly owned companies, their R sub S is roughly 3 to 5% higher than their bond yields. Okay, so what they're telling us is the bond yield is 12, and let's just use that 3 to 5% markup. And they just said use the middle range of 3 to 5, which obviously is 4. So the formula in this example is the bond rate, which is the 0.12, plus what we'll call the risk premium of 0.04. So I just add those two together and I get 16%. Okay, I'll convert that to a percent. So now I've got three different answers, 16.3, 15.4, and 16. And it said, what would be your estimated cost of equity based on this? Well, a great way to do this would be to sum the three, okay, and then divide by 3. So take those three numbers and divide them by 3, and that would be a great approach to use. Okay, and I get 15.9%. And that would be the answer, 15.9%. So keep in mind that I can't always use the three methods. I can only use this first method if we pay dividends. I can always use the second method though. If I had to be a publicly owned company and have a beta, of course. And then the last one only works if I have debt. So not all of these methods work, but if you can use all the methods, a great approach is simply to do each one, add them up, divide by 3, and the average would be the number that we would use when we go and compute the WACC. Okay, so that was chapter 9. Any questions? And then I'll be done. I knew this would take a little bit. It would take a while to cover this many problems, and I was right. It did take a few. Oh yeah, so let me go back to 9.6. So for 9.6 right here, they tried to throw us off the rails here, and we want to use the 10-year T-bond. Okay, so the T-bond, because that's really the true risk-free rate. Like if I said, go tell me what the risk-free rate is in the market, you always want to look at the 10-year T-bond. They gave us the short term, the T-bill, as just something to throw us off the rails. Okay, so risk-free rate is always the 10-year T-bond. Good question. Okay, yep, you're welcome. Glad you asked. Okay, unless there's any more questions, I will hang it up. Okay, as always, you can ask me questions, email, whatever. Yep, thanks, you're welcome. Thanks, Chris and Marlena. Okay, so I've got my recording still going, and the problem is that I forgot to record chapter 7. So for those of you listening to this, I realized that when I started recording chapter 9. And so I'm just going to do a real quick chapter 7 overview here with you. And I'm going to post this file that I use to do the calculations and answers also. So I think that'll help. But chapter 7 dealt with free cash flow. And what we're doing here is simply projecting the cash flow. And so they gave us 800 million worth of sales. I increased that by 1.1%. That's my year 1 numbers. Then in year 2, I increased sales by 1.05 to get 924. And they said that my operating profitability is 10%. And that gives me what I call my NOPAT, my net operating profit after tax, which is question 2. And so I take the 880 times 0.1, I take the 924 times 0.1, and that gives me my NOPAT for each of those 2 years. Then question 3 said, what's my operating capital? Well, I use this capital requirement ratio here of 0.8. And so I multiply my sales by 0.8, and I multiply sales again by 0.8. And then, so I get my operating capital of 704 and 739. And again, this is year 1, and this is year 2. And then my free cash flow is this formula down here, my NOPAT, minus the difference between operating capital in year 2 minus year 1. Cool. So I'm taking the NOPAT of 92.4, then I subtract year 2 operating capital from year 1 operating capital, hit enter, and I get 57.2 as my free cash flow, which is the answer to question 4. Okay, then question 2 dealt with free cash flow growth. This is my formula for free cash flow growth, the value of operations. And so I have free cash flow of 400,000. I multiply that by 1 plus G, 1.05. And then I take my WACC of 12%, and I subtract the growth rate of 5. And so I simplify my formulas, I divide, I get 6 million as my answer. So $6 million is my free cash flow. Then question 3 was the horizon value of free cash flows. And the key with this one was to calculate the growth rate right from here to here. And so I did that right here. I took the change, the current year minus the prior year. It's 42.45. I divide that by the prior year. So I take the change from 21 to 22. I divide that by 21. Divide, and I get a growth rate of 6%. And then I use that 6% to calculate the horizon value, because from years 21 and on, I'm computing an 6% growth rate. So I take that 750 right here, and I multiply that by 1.06 to get 795. Then I take my WACC of 11, I subtract the growth rate of 6, obviously that's 0.05, and I get right here, I divide those two numbers, I get 15.9 as my answer. Then question 5 is intrinsic value based on free cash flows. They gave us quite a bit of this info. We just had to build a little calculation here. So my value of operations they gave me was 800 million. They gave that to me right here. I add to that my short-term investments of 70. That's my total value. I then subtract my debt of 200 million. I subtract my preferred stock of 50 million. The difference then is my intrinsic value, my value minus my debt minus my preferred stock. I then divide that by the number of shares. That gives me what I believe is my intrinsic value per share of $62. Okay, then we go ahead and we look at the dividend growth valuation, and this is my formula for dividend growth. And so they gave me D1 is my dividends a year from now. They mentioned $1.50 of dividend at the end of the year, so that's my 150. I divide that by R sub S minus my growth rate. They said that R sub S is 13, my growth rate is 6, so that's 13 minus 6, which is 7. And then I just do the math. I just take the 1.5 divided by the 0.07, and I believe that the value of my stock is 21.43 based on that. So we can kind of use the same information that I used here, and I can then kind of twist it a little bit, and I can do this calculation. I can compute what's the required rate of return on a stock using the same input. So this question asks us two different things. What's the price of a stock a year from now? And then what is the R sub S on the stock? So this formula here is P0 times 1 plus G. So the numbers for that one are just right here. The P0 is 22. Then I multiply that by 1 plus G, and G is 10%. So I just multiply and I get the answer. My P1 is 2420. Then I take my R sub S, my required return on stock is D1, and D1 is 120, the D0 amount, multiplied by 1.1, the growth rate, to get 1.32. I divide that by P0, the $22, and I add to that the growth rate of 0.1. So I just do the math here. I take the 132 divided by 22. Then I add to that 0.1 plus the 0.06, and I get my answer of 16% as my R sub S. Then for preferred stocks, the R sub S is simply dividend divided by the value of the stock. 5 divided by 50 is 10%. Then for 11, it's basically just saying what's free cash flow under a few different scenarios. So we've got a $3 million free cash flow, and we require a 13% return. And then it says what's the estimated value of operations under 3 different growth rates. So we did this formula right here. The value of operations is FCF times 1 plus G divided by the WACC minus G. So that's what this is. This is the 3 million right here. And this is the 1 plus G. In the first one, it's a -5 plus 1 minus 0.05. Then we divide that by the WACC of 13. I subtract the negative, which means I'm adding back the growth rate of 18. I do the math here, and I get ultimately, I get 15.83 as my value of operations. For the second one, the growth rate was 0, so it's really easy. All I have to do with this one is take the $3 million and divide it by the WACC of 13 because there's no growth. Then the third one, the growth was 5% as a positive. So now I'm taking 3 million times 1.05. Then I take 0.13, I subtract 0.05, and then I just do the math here. Then I divide, I take the 315 divided by the 0.08, and I get 39.38. And the last one is based on a growth of 10%. So the 3 times 1 plus 0.1, 3%, 3.3. By multiplying, I divide, I get a value of 110,000. So it just shows you how significant growth rates are, especially going from 5 to 10, how that increases the value of the company. And the last one is Kendra Enterprises has some cash flows. They've got 80,000, then 100,000. Then they expect a constant growth of 8%, and the WACC is 12. So 80,000, 100,000, growth of 8 after year 2, WACC, cost of capital, is 12. So basically, I've got 100,000 increased by 0.08 to get 108. And then what I do is I take 108, I divide that by 0.04, which is 12% minus 8%, the WACC of 12 minus the growth rate of 8, to get 2,700,000 of free cash flow as my horizon value. That's my horizon value of cash flows. So the way my cash flow timeline works, in year 1 I get 80, in year 2 I get 100, in year 3 I get 108. And so what I have to do to value this is I have to bring those all down into a present value, which I did right here. So I'm using the present value calculation that we used from our present value chapter in the Excel file I gave you for that. So each one is like this. So I'll come back and redo these numbers. So 80,000 at 12% for 1 year is the 71,428. Then 100,000, 12% for 2 years is the 79,719. Then I have the horizon value, which is 2,700,000. Now keep that at 2 years because that's the last year. I go from year 2 to 3 increases by 8% every year after that. So that's why I use 2 as my calculation for horizon value. And the sum of those 3 numbers, that's the value of operations for my company. Okay, so that's what I forgot to record, but definitely I want you to have that to help you out. So if you have questions about anything in this chapter, let me know. As a reminder, only chapter 7 is due next week on the 26th, and then chapter 9 is due a week after on December 3rd. But clearly, you can work ahead if you would like to. You're always welcome to do that. Okay. Thank you very much.